Now. For those of you who don't know me, I'm Rick Willinger, and I'm a partner at Mercadien. My practice area, I specialize in tax and work primarily with closely held businesses and high net worth individuals, and doing a wide variety of tax planning and tax compliance services. Today, we're going to talk about some year-end tax planning. It's been an interesting year between the election and COVID and just things change, a lot of things changing. Tax planning has taken a little bit different twist than it has in the past. So we're going to go move to the next slide, and we're going to start off just talking about the election and what to expect from, or what I expect from that. As everybody knows, the Democrats have won control of the executive branch and the House of Representatives. Control of the Senate is still up in the air, and in my view, that's going to be a major factor in our tax policy going forward. If the Republicans are successful in maintaining control of the Senate, I think we're still going to be seeing tax changes over the next year, but I think they're going to be a lot more moderate than they might otherwise be. If the Democrats have control of the Senate as well as the White House and the House of Representatives, I suspect we're going to be seeing a lot more in the way of tax changes, and a lot more things will be similar to what President-elect Biden has stated as his tax policy moving forward. So with that, I think a general understanding of President-elect Biden's tax policy is probably in order. At the individual level, the Biden tax platform is looking at an increase in tax rates. The tax rates before the most recent reduction under President Trump was a 39.6% individual income tax rate. It's been reduced to 37%, and the Biden tax platform has that increasing back up to 39.6%. It's been stated that the only individuals that are going to see increases in their income taxes are for taxpayers making more than $400,000. And $400,000 is a nice compensation level for W-2 earners, but it really is not that high a compensation level for business owners, especially business owners of pass-through entities, partners in partnerships, shareholders in subcapital S corporations, because the businesses' taxes are actually paid at the individual level. So when you add the business's profits as well as what the individual is earning for the year, it's not uncommon for a lot of people to be making substantially more than $400,000 a year. So we're going to see a lot of people paying more taxes under the Biden tax plan. In addition to increasing the ordinary income tax rate at the upper end from 37% to 39.6%, the Biden tax platform is also going to be increasing the long-term capital gains rate for individuals that have income over $1 million from 20% to all the way to the maximum of 39.6%, practically doubling the long-term capital gain rate. And it's what has also been stated, and what I think is likely to happen, even if the Republicans do retain the Senate, is we may see an end to the state and local tax cap. But we'll have to wait and see on that. Next slide. For those of you that remember back a few years, there used to be a limitation on itemized deductions. As individuals earn more money, a portion of the itemized deductions got phased out, and that was called the peace limitation. The Biden tax platform is restoring the peace limitation, the phase out of itemized deductions for individuals with incomes over $400,000. The other thing that they're doing is that they're looking to expand the Social Security tax for incomes in excess of $400,000. Social Security taxes typically end at $130,000, $140,000 or so, and you stop paying in Social Security. There's going to be kind of a donut hole And at $400,000, if somebody is earning more than that, the Social Security taxes will kick in again and continue indefinitely. The other thing which has been very beneficial for owners of closely held businesses and pass-through entities has been this qualified business income deduction. And what that deduction is essentially is a deduction of 20% of the income, and it effectively takes you the tax rate from currently 37% on closely held business income down to 29.6%. Well, for individuals with income in excess of $400,000, again, there's a talk of phasing out the qualified business income deduction, and that would increase the tax rate from 29.6% to 39.6%. And just, I forgot to mention, just to go back to during my introduction, if during this presentation you have any questions, you can put it in the chat or the question and answer section and Lee Boss, one of my partners, is going to be monitoring that, and we'll try to address whatever questions we can towards the end of the presentation. Next slide, please. The Biden tax platform also is looking to increase corporate tax rates. The corporation tax rates were decreased under the Trump plan down to 21%. And under the Biden plan, the proposal right now is to increase it up to 28%, and to also institute a worldwide corporate minimum tax of 15% of worldwide accounting income. So to eliminate any kind of loopholes that there might be in worldwide tax planning. Estate planning is also would likely change. Currently, everybody has a lifetime exemption. It's indexed for inflation, so that's why it's kind of an odd amount. But it's right now it's $11,580,000 per person can be passed from one person to the next generation, either while you're alive or upon death, without paying any type of gift or estate tax. Beyond that, the estate or asset value of assets would be taxed at a 40% tax rate. For a married couple, that's $23 million or so. It's a substantial amount of money that could be transferred to the next generation without paying any type of tax. Under the Biden tax plan, that $11,580,000 is going to be reduced to $3.5 million per person, and the top rate is proposal is to increase it from 40% to 45%, thereby increasing the estate tax substantially. Finally, one of the major benefits of inherited assets is that the asset gets a tax basis in the hands of the person who inherits it of fair market value at date of death. So if somebody were holding securities for a long time, substantially appreciated, and they pass and it gets transferred to the next generation has a tax basis equal to the value on the date they inherited it, not what was paid originally. The Biden tax plan also proposal has an elimination of the step up in basis of assets, so that capital gain does not go away upon inheriting it. The plan does have some things to benefit lowering earning people. So there's an expanded earned income tax credit for older workers. There's an expanded dependent care credit to $8,000. Again, would be phased out. There's the elimination, and this has been talked about for a long time, but for private equity investors to eliminate this, what they consider the carried interest loophole, which is the ability of some wealthy investors in private equity to generate capital gains for their efforts as opposed to ordinary income. There's a concept of an automatic 401k that is being talked about. there's and a few other things, penalty-free hardship withdrawals for survivors of domestic violence and sexual assault, and a tax credit to small businesses to help offset the cost of starting and maintaining retirement plans. So on the next slide, so the question really is, with all these potential changes on the horizon, is normal tax planning really the right strategy for people to be looking at? Normally with tax planning, the general rules of thumb are you want to, if you have the ability to defer income into a future year, you do that. By deferring the income into a future year, you have the ability, you don't pay the tax to the future year. So if you can push something off a little bit, you do it from an income standpoint. You also look to accelerate deductions. The deduction today is worth more than the deduction in the future just because it reduces taxes today. Time value of money tells you that that's what you want to do. Well, is this really the right strategy for in 2020, considering a number of things. Number one is the tax proposals. If the Biden tax plan were to be enacted in full in 2021, for example, would it make sense to accelerate income into 2020 and pay tax at 37% as opposed to deferring the income to 2021 and paying 39.6%? Or if it's business income, paying tax at 29% versus 39%, a much bigger difference. Or if it's capital gains, locking in a capital gain at a 20% tax rate, as opposed to if somebody has a large capital gain and their income would be over $1 million, potentially paying almost 40% on that capital gain. So the question really is the normal income deferral, the deduction acceleration, the right strategy for 2020? And I wish I knew the answer, but we really don't know it for sure, but we could just factor some of those things into play. There's also certain provisions as part of the CARES Act. CARES Act being enacted earlier in the year to help stimulate the economy and help people through the COVID-19 pandemic. But a few things that are there are, for instance, the CARES Act allows net operating loss carrybacks. One of the things that was eliminated a few years ago was that if a business or an individual were to generate a net operating loss in a given year, there was no longer a carryback of net operating losses. So, and that loss could be carried forward and could offset income in the future. But at one point, they used to be able to carry it back and recover taxes for a couple of years back. What the CARES Act did was they enacted a net operating loss carryback for years 2018, 19, and 20, which would allow a business or an individual that had a net operating loss in any of those years to carry it back up to 5 years and recover taxes in prior periods. That does a few things. Number one, it gets cash in the hands of people when they needed it. Number two, in those early years, tax rates were a little bit higher. So a loss today could potentially recover taxes at even a higher tax rate. So if that's the case, the normal income tax planning strategies may actually make sense because by deferring income into the future or accelerating deductions, you may be able to create a net operating loss carryback that could then recover taxes at a higher tax rate and put current cash in your pocket. The next thing another provision that was put in as part of the COVID-19 provisions was a charitable contribution deduction equal to 100% of adjusted gross income. Under normal circumstances, cash contributions to public charities are deductible to the extent of 60% of adjusted gross income. For this year only, contributions are deductible up to 100% of adjusted gross income. So if somebody is charitably inclined in this type of environment, the ability to give much larger charitable contributions is there in the current year. They've also changed some of the ordering rules as to how the charitable contributions are deducted, and we do have some clients that are doing some tax planning around being able to use up some charitable contribution carryovers that they have from prior years before they expire, because these 100% charitable contributions in the ordering rules actually come last. So they would fill up your charitable contribution buckets and eventually become your carry forward and refresh them. They also put in waivers of the 10% penalty on early distributions from IRAs and retirement plans, as long as it's for a COVID-19 purpose. So if somebody is experiencing hardship because of the pandemic, they can invade their retirement plans. They're not going to save the tax on it, but if they're below retirement age, they can withdraw the money and avoid the 10% penalty. The other thing that a lot of people are looking at is they're looking at their estate plans again, with the potential that the lifetime exemption is going to be reduced substantially. They would like to lock in more of that $11 million lifetime exemption before it goes back down to $3.5 million. So checking out your estate, revisiting your estate plan is absolutely something that you would want to do sooner rather than later if you're in a position to be able to transfer assets now and utilize more of that lifetime exemption. Next slide, please. PPP loans has been a big topic over the last year. The PPP loan, Paycheck Protection Program loan, was a loan that was applied for by a lot of smaller businesses, which enabled them to maintain employees in the workforce during the pandemic and the economic downturn. In very simple terms, the business was able to borrow money, and provided that the funds were used for qualified purposes, primarily keeping people employed where they would otherwise need to lay people off, the loan converts from being actually a loan to being a grant. So as long as the money was spent for the appropriate purpose, there was it would not have to be repaid. What nobody considered originally when this was first put out was what would be the tax consequences of it. When the PPP loan came out, the headline was that if it was turned into a grant, the grant would not be taxable income. So it would be essentially tax-free income to the business. What wasn't necessarily thought through, I think initially it was somewhat of an oversight, but it wasn't, but it's pretty clear cut in the way the tax law is written today, is that it's fine. The forgiveness of the loan is not taxable, but there's provisions in the tax law that say to the extent you incur expenses to generate tax-free income, those expenses are not deductible. So the IRS came out with a position that even though the forgiveness of the PPP loan is not taxable income, the payroll expenses that you paid using the PPP loan are not tax deductible. So kind of a backdoor way of saying it is the forgiveness of the PPP loan became taxable. The IRS has made it clear that to the extent that a business believes that they've met all the requirements to have the loan forgiven, even if they haven't formally applied for the forgiveness or they haven't been notified that their forgiveness application has been accepted, the disallowance of the expenses is a 2020 event. So the income event will occur in 2020. and we're doing a lot of planning now around the fact that businesses that otherwise thought they were having moderate or even down years because of the downturn in the economy and the pandemic are actually finding that in many cases their profits are higher than they had been in the past because they have all these disallowed expenses associated with the PPP loans. So that's one thing not to get caught off guard on, is the fact that we set the cash flow expectations that taxes will need to be paid in 2020 on the PPP loan. There have been some bills in Congress to, in my opinion, to correct what was originally intended, that the PPP loan would in fact be completely tax-free. They haven't been gotten very far, but hopefully in the next Congress, once we get past the inauguration and so forth, that will get revisited, and there's some hope that it'll turn out that the PPP loan will not be generating any taxable income, and everybody's going to get a gift sometime during 2020, but we can't necessarily count on it. So the planning right now is that the PPP loan will be taxable. It may be prudent to plan on filing extensions for taxes next year to give time for that. If you have a PPP loan, to give time for this to be corrected or changed within the tax law. The alternative would be to file your tax return taxing the PPP proceeds for 2020, and if the law is changed, then file an amended return and getting a refund. But I personally think it's probably prudent to plan on filing an extension, at least for some period of time, until we kind of let the PPP loan provisions work their way through Congress. Also, in doing tax planning, we can't forget that there are states. And the states, although they very often follow the federal tax changes, they don't always follow them exactly. A lot of these COVID provisions are not being necessarily followed by the state or by all the states. Other examples are installment sales. Like Pennsylvania does not follow installment sale treatment. So if with an installment sale, if you were to sell an asset and get paid over a period of time on your federal income tax purposes, you would be paying tax on the gain as you get your payments on the installment note. In Pennsylvania, they do not recognize installment sales in the sale of a business. So if you were to sell a business and take back an installment note, although you're going to pay your federal tax as you receive your installment note, the state of Pennsylvania does not recognize that. Pennsylvania also doesn't recognize like-kind exchanges of property. And as I said, each state has their own rules for the COVID provisions. And finally, again, revisit estate planning, especially if with the reduction of the lifetime exemption and the increase in tax rates potentially coming, it's a good time to revisit it and maybe do some estate planning before the changes are actually made. Plan to maximize the qualified business income deduction. In 2020, we still have it. It's a 20% deduction for qualified business income in certain businesses. But in order to maximize that deduction, or to get that deduction, businesses need to have a certain amount of qualified wages. So make sure in doing the planning that in planning between, especially, and this comes into play most often with closely held S corporations, where the shareholder owner receives is the majority compensation earner, to kind of weigh their compensation deduction or their compensation amount with the business profits. But you want to make sure that you properly plan to have the appropriate amount of wages. Otherwise, you'll get to the end of the year, think that you have a great profit, all subject to a 29% tax rate, and find out that it's really taxable at 37% because there's not sufficient wages to support the deduction. Another thing which is new for this year is called New Jersey BAIT, Business Alternative Income Tax. This is a tax. This was enacted by the state of New Jersey. A few other states have done this as well, but New Jersey first implemented it for 2020, which allows partnerships, LLCs, and S corporations to pay state income taxes at the entity level rather than paying those state income taxes at the individual owner's level. The reason for putting this provision in place was to try to get around the limitation on the ability to deduct state and local taxes to only $10,000 for an individual. The IRS has blessed this type of a tax. They will respect this type of a tax as a strategy. So there's nothing aggressive about it. But by doing this, it's deducted against the profits of the business that pass through to the individual, and it's not deducted as an itemized deduction, and thereby gets around the state and local deduction cap. It's not an automatic. It definitely makes sense to do. It seems to make most sense to do it with companies that are primarily generating business income in the state of New Jersey and have owners that are primarily residents of the state of New Jersey. The reason that it's not necessarily a great strategy for somebody who's a non-resident in New Jersey is that the tax is being paid by the entity, not by the individual, but within their resident state, they would still have to pay tax on the profits. So it could create a double taxation situation. For instance, an individual lives in the state of Pennsylvania and has a business interest in New Jersey, where under normal circumstances, they would pay New Jersey non-resident tax, but claim a credit on their Pennsylvania return, so they're not double taxed. In this case, the entity would pay the tax in New Jersey, the individual would pay the tax in Pennsylvania, and that same income would essentially get taxed twice. So it's not, the advantage though still is that on their federal tax return, they're going to get a deduction for that New Jersey tax that would otherwise be paid. So it does require a little bit of analysis, especially if there are non-resident owners. But with resident owners and a large portion of the income being New Jersey sourced, it's a great strategy to implement. One of the keys, though, is that with this tax, especially if you're a cash basis taxpayer, although the election, it doesn't need to actually be made until March. If you want to get a tax deduction against 2020 federal income, an estimated tax payment for this business alternative income tax needs to be made by December 31st, and that needs to be done online on the New Jersey Division of Taxation website. But it's something not to miss that deadline. If the payment wasn't made until next year, it would still be deductible, but only against next year's income, not against this year's income. And finally, we also, with being an owner of pass-through entities, partnerships, LLCs, S corporations, especially with this possibly being not as good a profits year, make sure that there's sufficient tax basis to deduct losses and avoid unexpected income if you've taken distributions in excess of your basis in your entity. I just want to touch on, don't have a slide for this, but on some state tax issues. The way people have worked has changed a lot over the current year, and where a lot of people are working remotely. the states are not necessarily taking a uniform view of what that does. But for a company that is based in a certain state but has employees that are now working remotely from other states, we start to create a lot of potential tax issues as to, is the business now operating in another state? Does the business need to start filing tax returns in that other state? What state's income taxes should they be withholding from the individual's wages? And again, the states are not necessarily taking a uniform view of those. I mean, something very common for our client base is we have a lot of people that live in the state of New Jersey, and they generally work in New York. They can't work in New York. The offices their office closed down. They were required to work remotely, and they work a good portion of the year from the state of New Jersey. Where are they taxable on those wages? Are they taxable in New Jersey, or are they still taxable in New York and need to claim a credit for taxes paid by other jurisdictions? The equitable answer is that they're taxable in New Jersey. They worked in New Jersey. They didn't have a choice but to work in New Jersey. They couldn't have gone to New York to work if they wanted to. New York is taking a different position, unless they're viewing the New Jersey working as being temporary. As long as the main place of business for the company is New York, and that is where the person is based, and New York is taking the position that the days working at home is for the employee's benefit, not for the employer's benefit, and is considering it to be New York days. So those employees are still going to need to count those days as being New York days and claim a credit on the New Jersey return. New Jersey, as of now, I don't think intends to challenge that, but it will not surprise me if they see a large reduction in revenues in the state of New Jersey, that they don't challenge that position and say, no, you're working in New Jersey, we're not going to allow you a credit for New York days just because New York says that they want you to pay tax here. So I think we're going to start seeing some tension between the states, and hopefully it's not the taxpayers that end up footing the bill because they're going to have to litigate one state's tax laws against the others. A lot of states are putting in temporary policies. They're going to allow you, they're not going to necessarily assert these residency issues to temporarily, but how has this environment changed the way people are going to work long-term into the future? So even though many states may not assert residency issues and things of that nature, as long as we're still in the COVID-19 pandemic, if people are going to continue to work long-term on a remote basis, how is that going to affect the way people are taxed? Okay. From an individual standpoint, most states follow the same rules in determining whether somebody is a resident of the state and needs to pay income taxes there as a resident. And they typically have it's a two-pronged test, or two different way tests. One is if that's your principal, that you're domiciled there, that's your principal residence, that's what you consider home. The second way you could be considered a resident of the state is if you have a home there, it could be something that was otherwise a vacation home, and you spend more than any portion of 183 days in the state. Well, for a lot of people, especially during the pandemic, they may have gone to their second homes and spent substantial amounts of time working there. If they spent more than 183 days at their second home, and it happens to be in a different state than their first home, the state may consider them to be a resident of that state. And where their principal residence is, they're also going to consider them a resident of that state. So all of a sudden now they're a resident of two different states under two different sets of laws. Those issues are something that need to be watched pretty carefully, especially going forward as we start to come out of the pandemic, because states are going to be a lot less lenient as it relates to these state residency issues. Okay, finally, just in thinking it through, if you find yourself in a position where income acceleration is something that you would like to do, because you're going to handicap the race and say that you believe that taxes are going to be going up in the future, and you would like to accelerate any income you can into 2020, what are some strategies you can implement to possibly do that? Well, one would be to convert traditional IRAs into Roth IRAs. A second would be to accelerate required distributions from retirement accounts. Nobody was required to take a distribution in 2020, but that doesn't mean that you couldn't. So if you wanted to accelerate income into this year, take those distributions out. I mentioned it earlier, electing out of the, where we talked about installment sales for state tax purposes. If you were to sell an asset over a period of time, if you believe that taxes are going to go up into the future, the capital gains tax may go up substantially, you would have the opportunity to accelerate the entire gain into 2020, as opposed to paying the tax out as you receive the cash proceeds. So let's just assume that sold a business for $10 million this year with $2 million up front and $8 million next year. Under normal rules, you would pay tax on $2 million in 2020 and $8 million in 2021. But if you believe that the tax capital gains rate may go to 40% in 2021, you could elect to pay the tax on the entire $10 million in 2020 and not be at risk of the increase in tax rates in 2021. It's something to consider, especially if you're talking about a fairly short-term installment sale like that example, because the cost of accelerating the gain by 1 year is not that much. It's from a time value of money standpoint. You're talking about something that's going to be paid out over 10, 15 years. It's a little bit harder to justify. That's what the idea. You could harvest capital gains. You might have investments with substantial gains built in. And if you believe that tax rates are going to be going up in the future, or you have losses this year from other investments that you did sell, you could harvest those capital gains, sell the stocks, and there's no limitation on even buying back the exact same investment if you think it's going to be a good investment to hold for the future. It freshens up your basis, and in the future, you'd only pay tax on the gains that occur from this point forward. You could forego like-kind exchanges. You can structure, if you would normally be looking to sell a piece of real estate and possibly do a like-kind exchange so that you could defer that gain, you could structure the transaction so as to trigger the gain this year and refresh your tax basis. Exercise stock options. If you sold some stocks at a loss and you decide you really don't want to take the loss and you're still within a 60-day period, you could trigger the wash sale rules by just repurchasing the same stock within 60 days, and it would disallow your loss, and you could then take the loss again at some point in the future. And obviously look at different methods of accounting for changes. For instance, depreciation. I mean, right now we have bonus depreciation. If a business buys a piece of equipment and they want to, they can write off the entire cost of the purchase, the large piece of equipment this year. Well, if we think that tax rates are going up into the future, maybe elect not to take that bonus depreciation and write that asset off over 5 or 7 years or whatever the normal depreciation life may be, might be a strategy. So I know there were a lot of different concepts out there. I mean, some are related, some are unrelated, but just to kind of get different thoughts and strategies working. And with that, I guess I'm going to open it up and see if there's any questions. Are there any questions in the queue?
Yeah, Rick, great job. And just a reminder, as Rick mentioned, use the Q&A function. Should be at the bottom of your screen to post any questions that you may have for Rick. There was a few here, Rick, that I'm going to throw out to you. And as I ask these, anyone feel free to continue to put Q&A questions in that chat box down there at the bottom. But one just deals with the PPP loan and this whole question that you spoke about on the deductibility or non-deductibility of expenses right now. And the question really hinges on, when do we need to make our tax payments? Do we have to pay that in, any estimated liability, by the end of December? Because this question about what's going to happen with this ultimately, should we be fully paid in by the end of December, or at the time we do our extension, or at the time we file our actual tax return, if assuming we go on extension?
Well, normally in planning for estimated tax payments, for an individual, they need to have paid in either 100 or 110%, depending on their income levels, of the prior year tax. So for 2020, they need to have paid in either 100 or 110% of the 2019 tax, equally throughout the year. Or they need to have paid in their current year tax equally throughout the year if it happens to be low. So with the PPP loan income coming in, and assuming that the income is going to be substantially higher, as long as payments have been made equal to that 100 or 110% of the prior year tax throughout the year, there's not going to be any penalties, and any balance that might be due can be paid at your normal extension time, which I would expect to be for an individual April 15th of 2021. Last year it got moved a little bit because of the pandemic, but I don't necessarily suspect that's going to happen again. So you have until April 15th to pay, if there's a large increase in income, to pay all that extra if need be.
Great, thanks, Rick. Another question just about the tax rates that you spoke about, assuming that the Democrats take control of the Senate. You mentioned that it would be more likely that some of these tax changes will occur. And so the question is more the timing of that. Will that be effective, you believe, in 2021, or is it going to take longer for all this to kind of work its way through? Any views on that?
Yeah, I suspect we're going to start seeing some changes in 2021 in the tax laws, and a lot is going to depend on control of the Senate. I mean, the Democrats I think it's much more likely we're going to see larger changes for 2021 if the Democrats take control of the Senate. If they don't take control, if the Republicans retain control of the Senate, I think we're going to see much more moderate changes, although I still think we're going to see some. I mean, I've seen, for instance, some Republicans actually show support for the state and local tax deduction. So that may be a change that they may be able to get through and would benefit a lot of the higher tax states like the state of New Jersey, if possible. But as far as wholesale tax rate changes, I think it's much more likely that we'll see it in 2021 if the Senate changes control.
Great, thanks, Rick. Another question going to this New Jersey bait program that you spoke of.
Right.
So are the rates the same, like the rate that's applied at the entity level the same as it would be at the individual level, or there's some rate difference there?
There's some rate difference. I mean, there's a separate table that gets used, and the rates actually happen to be higher than the regular New Jersey tax rates. The New Jersey bait is only on the New Jersey source income. So if it's a multi-state business, the New Jersey bait would only be taxable on the New Jersey allocable income, but at these higher tax rates. But the way the New Jersey bait works is, to the extent that the New Jersey bait is more than what would be needed for the individual to pay the tax at the individual level, it creates a refundable credit. So the individual is not going to be paying tax at a higher tax rate because of it. Ultimately, they may have, from a cash flow standpoint, it may require paying cash out sooner, but and then wait for the refund, but the rate will not be any higher that they'll end up paying on that same income.
So another question on the New Jersey bait is, is this legitimate? And the question is more about on a federal level. Is this something that would be challenged because there is this state and local income tax? You can only deduct so much. So is this something that is going to expose us as a taxpayer?
If you asked me that question 2 months ago, I would have said that it very well may be challenged because it is clearly a workaround to get around the state and local tax deduction limitation. But the IRS has issued a couple pronouncements specifically blessing this type of a tax. New Jersey's not the first state to do it. Connecticut's done it for a couple of years, and there's 5 or 6 other states that have also implemented it in advance, but the IRS has blessed it, so it's not even controversial at this point. It's absolutely deductible for federal income tax.
Okay. Another question just on, it must be a popular topic today, this New Jersey bait, but so you spoke about, how the salt, you just mentioned too, with the salt, deduction, they might allow more deductibility if that could get reversed. So are you stuck with this New Jersey bait election here once you do it at the corporate entity?
It's a year-by-year election. So you can make the election for 2020, and if in 2021 the state and local tax deduction is back and it's no longer beneficial, the entity doesn't need to make it ever again.
Okay. Another question actually on estate planning that we have here, and you mentioned it could be beneficial given the fact that the exemptions likely may decline as well as an increase in the tax rate for a state. You said it could make sense to revisit your estate planning. What could you elaborate on how you would do that, or what do you mean by that?
Okay. There's not one particular strategy that you might want to implement. I mean, one example might be, for instance, for someone who has sufficient assets, they're not going to miss them. Essentially, they have plenty of assets for the rest of their lives. If they were to transfer assets to their children today in excess of the $3.5 million exemption that they're looking at rolling it back to, generally, if once it's gifted away, the IRS would not claw back. The government would not claw back any amounts given away in excess of that $3.5 million. So, if, for instance, somebody could afford to give away $10 million this year to the next generation, and they were to do it before the exemption goes down, they would not pay any gift or estate tax doing it. And then if the exemption gets clawed back to $3.5 million, they'll have now transferred $6.5 million more to the next generation without ever paying a estate or gift tax on it. So it's just taking advantage of the laws the way they are today before they reverse course and become less beneficial in the future.
Another question just coming in about, the different entity choices you have, like an LLC, an S Corp, those things.
Right.
Is there any, with these changes, anything to relook at from that perspective?
Choice of entity is, we could spend hours talking about the pros and cons of each of the different choices of entities. There's nothing here in particular to take a look at. There were some companies were looking at deciding when the corporate tax rates was decreased to 21% to whether they want to give up pass-through entity status, for instance, because the 21% tax rate is better than a 37% individual tax rate or even a 29% individual tax rate after the QBI deduction. If anything, if an analysis and change wasn't made previously, it's probably time to kind of hold up on looking at that right now, because again, we don't know where the rates are going to settle. And if the corporate tax rate now goes up to 28% as the Biden tax proposal has it, it may not be as beneficial to give up the pass-through entity status. So if anything, I would say it's time to put it in a holding pattern, if anything, to look at looking to change type of entity status.
Great. Another question just about, you spoke about like the installment sale. Like, is this, obviously it's been a tough time for businesses. Is this a good time to look to possibly sell a business?
That the answer is maybe. That's very dependent on industries. I mean, some businesses are doing very well, and it might be an opportune time to sell a business. Other businesses, maybe because of the environment, have lost a little bit of value, and it may not be the right time to test the waters on a sale, and might want to let the economy kind of turn around a little bit more and come back to where things were a year ago from a value standpoint. So it's hard to say whether now is the right time for any particular business to be looking to do a transaction or not. I mean, we do see more activity starting to heat up a little bit in that regard. I mean, more companies are starting to look at that. I mean, a lot of people are changing the way they're viewing life, and saying people are making more retirement decisions now than in the past. So that's a very individualized question, both personally for the individuals as well as the different industries that we're talking about.
Great, Rick. Well, I'm looking at the Q&A and I don't see any more Q&A coming in here. So I think that I think you did a very thorough job, and really appreciate all your insight in a very difficult year from a tax planning perspective for sure. So Rick, if you had any parting comments or thoughts that you wanted to share with the group.
I just want to thank everybody for attending, and my contact information is on the slide. And if anybody has any questions or would like to talk about tax planning, please contact me.
Great. Thank you, Rick.
Thanks.
Everybody.